Hi, everybody. Thank you for being here today for our market-based accounting for clean fuels webinar. We're super excited to be able to share the results of our guidance document that we've been working on over the past year and then dive into a big panelist discussion. My name is Renee O'Donnell, and I'll be your moderator today. I'm the manager of the Clean Energy Accounting Project, or also known as CEAP, which is kind of the topic of today's conversation. I'm excited to introduce you all to our fantastic panelists and host a lively discussion on all things clean fuels. Oh, give me 1 second. Great. So we're kicking things off now. Now we followed by a brief background on both CRS and CEAP and how this guidance document initially came to be. We'll share some context on the creation of the guidance document and what the final results of the initiative are, specifically focusing on the 9 quality criteria that our team narrowed down. We'll then dive into the bulk of the webinar, which will be our panelist discussion. I'll be posting questions to all of our speakers, but during this time, I also encourage you to put all your questions into the Q&A chat at the bottom of your Zoom screen. There'll be about 10 to 15 minutes at the end for me to ask the panelists all your questions. If we're unable to get to all your questions today, our team will follow up individually with you with our email responses. I'm excited to introduce our expert panelists for today's webinar session, starting with Chris Cooper, CRS's very own policy director. He was a critical part of drafting the market-based accounting for clean fuels guidance. He's been on quite the speaking tour over the past few months promoting this guidance, and both CRS and the clean fuels industry in general are fortunate to have his knowledge here with us today. Next is Tim Hammers, our European perspective and a critical member of the guidance's working group. Tim is part of the European Renewable Gas Registry and brings unique perspectives to today's conversation. Next is Dr. Sinha with electric hydrogen, and they helped contribute the hydrogen perspective during our creation of this guidance document, and they also bring years of experience in resource efficiency, product stewardship, and carbon management to the conversation. Finally is Jeff Dietz, Senior Director at the RNG Coalition. Jeff was also an important addition to this initiative's working group and has been working diligently to expand RNG's position in federal, regulatory, and voluntary advocacy work. Thank you all for your participation in today's conversation and for your ongoing work in these important fields. A few housekeeping notes. This webinar is being recorded, and the link will be shared with you all via email directly after we conclude today's conversation, via our LinkedIn page, and also on our CRS website. Again, there is an opportunity for you to ask questions using the Q&A feature at the bottom of your Zoom screen. And please ask questions. We have about 15 minutes at the end to go through these. And again, if we aren't able to get to everyone's questions, we'll follow up directly via email. If you are interested in learning more about the content discussed today, please reach out to me directly and we'll happily set up a one-on-one meeting. Our panelists have so much knowledge on the subject, it's hard to squeeze it all into a webinar, and believe me, they do want to talk about it. So please reach out. We can get you guys set up with whoever you need to get all the information that you'd like. Before we dive into the webinar content, I first wanted to give you some context into CRS and to CEAP in general. Based in San Francisco, the Center for Resource Solutions was founded in 1997 as a space to advance clean energy solutions and assist the growing markets. We advocate for clean energy market development at the federal, regulatory, and voluntary levels. Over the past 25 plus years, we've grown into multiple departments, including our most well-known Green E verification program, our advisory services wing, our annual US and Asia Renewable Energy Markets Conference, and also the subject of today's webinar, the Clean Energy Accounting Project, or CEAP. The topic of this webinar, market-based accounting for clean fuels, was developed within the CEAP program. Each year, CEAP chooses 3 to 4 initiatives to focus our attention on within the realm of clean energy and carbon accounting. These initiatives are chosen by an advisory committee of leaders in the field of clean energy procurement and management. Once the CRS team and the advisory committee identify the most pressing questions in the clean energy space, we get to work assembling working groups of experts in the field to help us answer these big questions. These working groups are consensus-based and collaborative, and we like to work together to find these answers to our industry's biggest outstanding questions. Once the working group concludes on an initiative topic, our CRS policy and market development team draft a guidance document that combines the conversations we had during these working group sessions into a cohesive guidance document. These guidance documents are free to access for all, with the goal of CEAP to bring clarity and consistency to clean energy and carbon accounting principles. Here are our current advisory committee members who helped shape the direction of our active and upcoming initiatives. We actually do have currently a few openings on our advisory committee and opportunities to sponsor some of our upcoming initiatives. If you are interested in getting more involved and working alongside us and the policy and market development team here at CRS, please contact me. We can set up a time to discuss how our organizations can work together. All right, let's dive into today's main subject, which is market-based accounting for clean fuels guidance. This initiative focused on the primary question of what are credible market-based rules to account for the direct emissions associated with the use of clean fuels. The final report aligns with the accounting principles and attributional accounting framework adopted under the Greenhouse Gas Protocol corporate standard. It's intended to serve as interim guidance until the GHG protocol and other standard-setting organizations are able to provide more detailed direction on using these market-based accounting principles, specifically in reporting emissions inventories. Any organization that buys or sells contractual instruments for clean fuels and wants to account for their emissions under the Greenhouse Gas Protocol or a similar program based under the Greenhouse Gas Protocol's corporate standard will definitely value this report as an interim guidance until the Greenhouse Gas Protocol and other official standard setters are able to provide more definitive direction. We were able to narrow down these quality criteria to 9 total. It was definitely a challenge to do that, but we were able to pull it off. And here they are. We explored topics in the field of conveyance, aggregation, market boundaries, vintage, equivalency, attribute allocation, input instrument retirement, default attributes, and tracking retirement. We believe these boundaries keep clean fuels accounting on track. Our team worked tirelessly to ensure that the organizations who want to use clean, low carbon fuels to reduce their carbon footprint have the proper guidance and boundaries for reporting their greenhouse gas inventories. We'll be going into detail on some of these quality criteria during our panel conversation today. Here at CEAP, all of our guidance documents are developed using a consensus-based approach. This is a complete list of our working group participants, and we are so incredibly appreciative of their contributions to this project, many of who are on this call today. CEAP would not function without our fantastic expert-stacked working groups, and this initiative relied especially heavily on the knowledge of these individuals and their organization. So thank you all for your participation. And if you are ever interested in joining a working group, we'd be happy to have you. All right, so thank you for your patience for that short intro as we set the stage for our panelist discussion today. I'm going to stop sharing my screen and open it up to our 4 panelists. Hey, everybody.
Hi there, Renee. Good morning.
Thank you all for being here today. I wanted to just let you all introduce yourselves personally first. I think we're still waiting on Tim, who's on our European contact, but we can get started with the 3 of you first. Chris, if you'd like to introduce yourself.
Yeah, hi, I'm Chris Cooper. I'm a policy director here at the Center for Resource Solutions, CRS, and I was the principal drafter of the guidance for market-based accounting for clean fuels.
Awesome, thanks, Chris. Ricky?
Hi, Renee. My name is Ricky Sinha. I'm a director of sustainability at Electric Hydrogen. We provided comments on the hydrogen case studies in the report. Electric Hydrogen is a manufacturer of electrolyzer plants. We're US based, have a gigafactory in Massachusetts making electrolyzer stacks, and then we have a testing facility in San Jose, California that's testing a 10 megawatt electrolyzer plant. And just this week, we announced a project in Texas that's led by Infinium, and it's a ESAF, or Sustainable Aviation Fuel production facility, largest in the world, and we're providing the electrolyzer equipment for that facility. So we're excited to contribute to the accounting of attributes for clean fuels.
Awesome. Thank you so much for your work. And then Jeff?
Great. Thanks, Renee. Can you hear me?
Yeah, all good.
Great. So I appreciate the opportunity to join. I'm Jeff Dietz, Senior Director of Federal Government Affairs at Coalition for Renewable Natural Gas. So I manage all of our federal regulatory, legislative, and regulatory and policy related efforts, but I also then manage our engagement on voluntary markets and international regulated markets as well. So very much looking forward to participating here, and thanks again for the opportunity to join.
Awesome. Thank you all for those introductions. First, I wanted to direct a question specifically to Jeff and Ricky with your respective fuels that you've been working on. I'm curious to learn more about how the previous lack of guidance from other organizations have impacted investments in these nascent markets for your fuel specifically. So prior to this kind of guidance being out, how has that been affecting some of the work that you were able to do? We can start with Ricky.
Sure. I actually worked in the solar industry for about 14 years with First Solar, and so we saw the progression of the industry from a nascent market into a more mature market, and the market based instruments are really crucial there. Like, we're specifically talking about renewable energy certificates that are used to enable buyers to access renewable electricity, even if they don't have direct connection to a plant, a wind or solar plant. They can buy these attributes and thereby enable those plants to get built. And especially in a nascent market, that attribute provides an economic incentive for the growth of that industry. And in the renewable fuels area, it's also a nascent market now, and there are these barriers. There's a physical delivery barrier where you may not have access to that molecule that you want, and then there's the cost gap of you may not be able to pay the premium that currently exists for these. So these instruments are really crucial for addressing both cost gaps and physical delivery barriers. And to date, we have not seen the ability to credibly use instruments in the clean fuels sector. It's been available for electricity for a long time, but without the accounting rules in place, a buyer of these instruments is going to be at risk. They're going to be spending money, but not necessarily being able to make the claim they want to make. And so I think it's really crucial that these rules are being put into place now.
Yeah, I completely agree. Jeff, what do you think?
Sure. No, so over the last several years, Renee, I think we've definitely seen more adoption of RNG kind of in the voluntary market space, where utilities and corporations had begun to take on kind of more of a visible purchasing role, and largely using market-based instruments like renewable thermal certificates or through bilateral contracts. And that's helped the RNG market in the U.S. and in North America kind of evolve beyond its traditional kind of transportation sector footprint, largely in the compliance market. And those entities, those utilities, corporations, are entering the space really to reduce greenhouse gas emissions in their operations, often driven by ESG related goals and reporting requirements. And in many instances, RNG offers a quicker route to market than other low GHG emissions fuels at current, like clean hydrogen, which are still scaling and developing. We've seen more entities kind of signing long-term contracts for offtake, rather than initiating projects to generate credits in transportation-linked compliance markets. Right, that was sort of some of the early, I think momentum we saw. Of recent, in the last couple of years, I think the voluntary market has really been stalled, particularly given lack of guidance from greenhouse gas protocol in particular. We have a couple kind of high-profile offtake agreements, but these are largely limited to bigger companies that have the revenues to not only pay a premium for RNG, but a willingness to take on kind of what I would call a voluntary market risk premium. So a few big companies that have serious GHG reduction goals want to reduce their Scope 1 emissions, and they recognize that electrification may not be an option. But in many instances, a lot of other companies, they're not going to be able to do that because RNG is both incrementally more expensive, and there also just isn't that instruction, right? Namely from GHG protocol and the most, the most widely used GHG accounting standard in the world. So that has had the practical effect of sort of preventing greater market uptake and sort of, dampening voluntary market demand.
Awesome. Thank you both for that input. Chris, don't want to leave you out if you have something to add to that question.
No, I mean, this is pretty much consistent with what CRS and CEAP understood going into this initiative, is that there's a certain amount of pent-up demand in the voluntary market that would be released but for the lack of guidance from GHGP. So the idea was that our guidance could act as interim guidance and free up that demand while GHGP is doing its update of the corporate standard. So hopefully that occurs. We'll see.
Yeah, I think that the Greenhouse Gas Protocol is working on trying to get a document out by sometime in 2028. How significantly do you think that the markets are going to change over the next few years to be able to, have our guidance be somewhat of an interim support during that period of time?
Is that to me?
Yeah, go ahead.
Okay. So, well, prior to the administration sort of putting a halt on the IRA stuff and pulling some of that back, I would have said there would be a large amount of evolution. I mean, 3 years is a long time in even in a fuels market that moves fairly slowly. That said, even without the IRA incentives and with the administration sort of creating an atmosphere of uncertainty, 3 years is still a long time, and there's a lot of innovation that can take place in 3 years. There's a lot of production capacity that can come online in 3 years, and more importantly, I think it's more of it can happen with guidance, with some sort of impetus and some sort of clear instructions on how they can use market-based instruments. Than not. Then without the ability to use market-based accounting, I think that those both the fuels sector and markets, both RNG and hydrogen, as well as things like sustainable aviation fuel, aren't going to get off the ground at all. But with the ability of market-based instruments to increase investment in these early nascent production facilities, I think there's at least a chance that there'll be quite some evolution in the clean fuels markets by the time that GHGP puts out its guidance.
Great, that's good to hear. Any other comments before I move on?
Yeah, I would say that it's actually even more important than ever to have market-based instruments for nascent markets, given the risk to the regulatory environment, the IRA, and without those tax credits, you need the voluntary market to kick in and create financial incentives for building these projects. And so we really benefit from having these rules in place now.
That's great to hear. Jeff, anything from you?
Yeah, I mean, the only thing I would add, and 100% agree with Ricky's comments and Chris's there, but I think market-based accounting for renewable gas derived fuels. I mean, this critically important, right, in the voluntary market, not just to establish, right, as given kind of the current regulatory uncertainty, particularly in the US, but it establishes and creates, I think, an important precedent and a good signal to regulators the world over at various levels of jurisdiction, that market-based accounting of biomethane or any other low carbon gas can be done so in a credible way, and that transactions can be verified, and that there's mutual recognition of some of these frameworks and these procedures at multiple levels of government jurisdiction and across the world. And so it has an important signaling effect, right, for regulators just the same. There is a certain kind of symbiosis between the voluntary markets and compliance markets. So in a time of regulatory uncertainty for compliance markets, the regulatory market, or rather the voluntary market, and the standards and the frameworks and the guidance that helps kind of inform those markets can have a long-term and enduring effect to move the needle, amongst regulatory agencies the world over.
Yeah, absolutely. We were drafting this guidance and putting together the working group specifically, we wanted to ensure that we had a good spread of interdisciplinary actors who would be able to contribute their inputs from the federal, the regulatory, and the voluntary spaces to be able to make sure that this guidance can be widely used across all those sectors. But great, thank you guys for your thoughts on those. I'll open this up to all of you, whichever one of you guys wants to jump in first. I'm curious to learn what issues in your sector or industry specifically are cleared up by the introduction of this guidance and those 9 quality criteria that we were able to collectively identify. How can you use this guidance to solve some of the problems that you're currently facing to be able to advance the work that you're doing?
I could start. I think just at a high level, the guidance takes a lot of the approaches that are already being used for Scope 2 accounting of electricity attributes and applies them to fuels, which is a great step to open up market-based accounting beyond electricity. And that can help with Scope 1, it can help with Scope 3. I wanted to point out there is a particular definition equivalency that is particularly relevant to the hydrogen sector. So when you think about hydrogen, there's no carbon atom in hydrogen, so there's no emissions. When you use hydrogen, there's no greenhouse gas emissions. Hydrogen is not a Kyoto Protocol gas, so there's actually nothing to do with on the Scope 1 side. If you're a hydrogen user, but hydrogen does have versatility in the sense that on a BTU basis, it can be used interchangeably with natural gas. And so if you're a natural gas user and you're switching over to hydrogen in a use that's fit for that purpose, then there may be a place for Scope 1 accounting to play a role. But that would require equivalency to be defined not on a molecule or molecule basis, but more on an energy basis. So, for example, it's really easy if you're a user of conventional hydrogen and switching over to electrolytic hydrogen, that it's the same molecule. And same is true for biomethane switching in place of natural gas. It's the same molecule. So equivalency is really easily defined there. But if you're if let's say you're a fuel cell user and you're using gas and you're now switching over to hydrogen on a BTU basis, it's not the same molecule anymore, but it is the same amount of energy. And so equivalency, if it's defined a little more broadly as fit for purpose rather than just molecule for molecule, it actually opens up Scope 1 accounting to be more powerful a force for decarbonization. Because in the end, if you do make that switch, you're going to reduce emissions to the atmosphere. So there's no doubt that there's a benefit for decarbonization. The doubt is whether the buyer of that attribute can make the claim. And so I just wanted to bring up this equivalency as a really important definition in the guidance. Just a second point is that even though there's no emissions, if you're using hydrogen on a Scope 1 basis, there are Scope 3 emissions in the sense that the normal way to make hydrogen is to start with natural gas as the feedstock under steam methane reforming. And that does have pretty significant greenhouse gas emissions, about roughly 10 kilograms of CO2 per kilogram of hydrogen upstream. So in Scope 3, category 3. So there is another place for these attributes to make a role in Scope 3 accounting, which is important to many companies, but maybe not as fundamental as Scope 1 accounting. So.
Awesome.
I should just
Yeah,
clarify
Chris.
one thing too, that the guidance, the quality criteria that Ricky is talking about, the equivalency criteria, which I believe is number 5, does have a fit for purpose explanation to it. But the real impetus behind that equivalency criterion is that we follow the attributes, the claimed attributes, as opposed to the molecules themselves, which permits then a single instrument to represent either a fuel, its derivatives, or even its precursor chemicals, so long as the claimed attributes are attached to whatever the molecule happens to be. This is important for things like RNG as well, though, because we don't require any sort of change in certificate or retirement of certificate, and a new certificate being issued on the basis of a phase change of the fuel. So you can switch and turn RNG into LNG for passage across the Atlantic, turn it back into a gaseous fuel, and there's no need to create new certificates on every step along the line there.
Mhm.
It's the attributes that are key.
Awesome. Glad to hear it. Steph, anything from you?
Yeah, I think yes, one issue does the CF guidance clear up? I mean, I think, I would say it's really the totality of the guidance as in general that provides, I think, a valuable benchmark for RNG. I think first and foremost, just with regard to procurement best practices, right? Enabling market-based procurement of RNG for end users to establish emissions reductions, right? To really helps set up RNG as a very viable corporate decarbonization strategy. But I think the guidance also helps end users understand, and it amplifies kind of the broader contours of what exactly credible procurement for RNG looks like, right? From sourcing to registry usage in terms of talking about various contract structures. And then second, so procurement best practices, I think certificate tracking and verification as well, emphasizing the role of not just, EACs for low carbon gas, like renewable thermal certificates, which are critically important, but also explicitly references kind of bilateral contracts where we have a lot of voluntary market agreements in the U.S. established on gas swap contracts, which are used as a contractual instrument in lieu of certificates. So I think just generally in the U.S., obviously, market-based instruments for renewable electricity are just far better understood and recognized than those for low carbon gas and sustainable molecules. And so, I think that amplification is critically important. I know we'll get into, kind of the elements around market boundaries, but the broad contours of market boundaries, I think, for end users are also encouraging.
Yeah, absolutely. Thank you for bringing up the market boundaries conversation. I know that was a big discussion internally and with our working group for quite a while. Chris, do you have anything you want to clarify about the market boundaries section within the guidance doc?
Well, yeah, I mean, you're right. It was the stickiest issue that we had. It took the longest to sort of resolve and get consensus around. But where we ended up is sort of a novel place. The way we define market boundaries in the guidance is basically that there's 5 conditions that have to be met in order for shared distribution networks. And I should clarify, we use shared distribution networks in the guidance in a very specific way that's different from the way that the term of art is used within the fuels sector. When we say shared distribution network, the guidance means, and there's some clarification about this, a distribution network in which fuels, different types of fuels, or fuels from different sources are mixed, such that it's impractical or impossible to track or trace a fuel from its origins to its end use. And that aspect is very important because it's that lack of traceability that really was the enabling feature of the market-based instruments on the electricity side that we've been using now for over 2 decades. It's because you can't trace renewable energy, a renewable electricity. You can't trace an electron that was produced from the solar PV panel. anywhere to an end user and say that it got there, because once it's on the grid, it's all the same thing. It's all just charge, it's power. And it all happens instantaneously, which means like anybody who's connected to the grid at any particular time is just as likely to be powered from the power plant down the street as one all the way across the nation if they're so interconnected. Fuels is a little different. It doesn't quite operate the way the power grid does. But one prerequisite for our guidance and for the ability, I think, to use market-based instruments to make credible use claims is that same kind of mixing, the lack of traceability. So we're really talking about fuels that share a common carrier pipeline system, or otherwise might, like for instance, sustainable aviation fuel might not be pipelined, but a lot of the times it's mixed in the storage, the fuel storage farms at airports, so that every airplane is actually getting some amount of that fuel. So, but that's kind of what's key, first off. But in order to have two systems, like two different, not connected distribution systems that have mixed fuels in it, to constitute a single market by which you can transact a single certificate, we have these 5 conditions, and you can read them in the guidance, but there are things like the fuel has to be mixed at both ends, at both where the fuel was injected and where it's taken off has to be mixed. The certificates have to be recognized as legitimate on both ends, both where the fuel was injected and where the fuel was off taken. One of the most important, though, aspects of it is connectivity. While there's not a requirement that the systems be connected physically per se, we do say that the claimants has to have operations that physically connect to both of the systems. And the reasoning behind this is basically that the claimant themselves, if they have operations in both those systems, can act as the conduit by which the fuel can flow from one distribution system into another. And there's practically indistinguishable between those fuels. Once that's the case and it constitutes a single market, or the guidance allows the claimant to claim as much of the volume of the fuel is present within the entire market. So within both of the, or more, 2, 3, however many distribution systems are linked to the market. And I think that's really important because it allows some of these nascent, alternative fuels to have, basically expand access to the market to investors who wouldn't otherwise have access because they're not physically connected to the distribution network for the fuel.
Awesome. Thank you for that, Chris. I know that might have gone a little too over everybody's heads. There's a lot of details that we're working on in that market-based or market boundary section. But thank you for that intro, Chris. And if anyone has any other additional questions about that section, definitely reach out to us. We're happy to jump on a call. I just wanted to start getting to some of our last couple of questions here, and then we're getting some great ones from you all in the Q&A. So appreciate you guys putting those in. But I wanted to kind of learn more, some solider examples about how you foresee your sector being able to use this guidance, and where do we go from here? Some hopeful additions to what we're going to be able to grow off of this guidance, and how you see specifically your industry being able to leverage this to continue to grow out these clean fuels markets. Ricky, if we could start with you.
Sure. And I think it might be easiest if I give you in words, like a simple case study that builds on an example in the report. This is from section 1.2, I believe, in the report. And so imagine that I'm a developer in the hydrogen industry. I'm looking to develop a project in the country, and I find a stranded renewable asset, wind or solar, that's close by to an off-taker of hydrogen, let's say a refinery. And so I go over to that stranded renewable asset and I repower it to make it perform at a better capacity factor, and then I'm able to install an electrolyzer plant in the same location and generate hydrogen at a reasonable cost. Let's say $2.50 per kilogram. But my off-taker, who the refinery nearby, is only willing to pay $1 per kilogram, and so I have a cost gap of $1.50. Question is, how would you fill that cost gap? Well, these market instruments could be the way, and so the first step would be to get that hydrogen certified, so that a buyer of that instrument is comfortable that it's credible. And so there is a couple of ways to do that. There's the Emirates registry has created these renewable thermal certificates that are on a million BTU basis, and so you could get it certified through that registry. The CRS is also working on a Greenie renewable fuel standard, similar to the Greenie REC for electricity standards, and so you could get, once that's in place, you could get the Greenie certificate. Once you have those in hand, you would go look for a buyer of those certificates, somebody who has some willingness to pay a little more for renewable hydrogen, and so in the example in the report, it would be a data center operator who's currently using conventional hydrogen. They buy the certificate and they're able to claim renewable hydrogen. And that's all straightforward. The equivalency is exactly the same in the molecule. The variant of that example is where the data center operator is using natural gas, because we're actually observing that with the AI and data center growth, there's a huge increase in natural gas demand for powering these AI data centers, and so more likely than not, they may be using natural gas, and again, on a BTU basis, they could potentially use the hydrogen certificate to mitigate those the use of gas. And but in either case, the physical delivery problem of having access to renewable hydrogen and then the cost gap are kind of met through this instrument, and it allows that project that currently is $1.50 low to proceed. And so we would love to see a pilot like such as this to and to kind of prove this all out. That would be ideal, and that's something we're trying to figure out how to make happen.
Yeah, we'd appreciate that too. And thank you for the Greenie shout out there. But all right, same question to you, Jeff. How do you foresee your sector using this guidance? And then where do we go from here?
Yeah, so I mean, I think, look, the guidance provides just a really useful marker, I think, regarding just the credible and well-recognized trade of RNG and associated market-based, just the role generally of market-based procurement of low-carbon gas playing a meaningful role in corporate decarbonization. So I think that's sort of the first piece, and we as an industry want to amplify that as a very foundational point. I think we'll need to continue to better understand kind of the specifics of how certain RNG transactions map to the various quality criteria, and in particular to some of those conditions that that Chris laid out with regard to market boundaries, for example. And then we also need to just continue to we need to gauge end user sentiment as to whether the guidance hits the mark across different types of transactions. So I think similarly would love to see kind of piloting, but we also want to make additional outreach to corporates and other end users to better understand kind of what their management criteria requirements are, what is required to hand to an auditor. I think RNG fortunately has a lot of the market infrastructure to complement the guidance. So it may then be about just assessing like what additional accounting and reporting documentation elements does an end user need in order to satisfy an audit. And then, yeah, I think we need to, I think that mapping of different RNG transactions, both For example, within and amongst, say, distribution networks, shared distribution networks in particular, those need to be sort of, vetted and kind of pressure tested to a certain degree. But no, I mean, we've got high hopes for sort of next steps, and looking forward to engage both with CRS, and then the RNG value chain from producers through marketers, all the way through to end users of the fuel.
Yes, it definitely takes a village to be able to make sure this is going to go smoothly. So I agree with that last point. I wanted to give one last question to Chris before we jump into some of the fantastic questions that you've all been submitting. Chris, how does CRS specifically intend to leverage this guidance to continue addressing our primary goal of the organization, which is to grow and support clean energy markets?
Right. Yeah, we have to kind of have to remind ourselves we had to balance sort of two, not necessarily mutually exclusive or even competing, but two different sort of objectives with the guidance, and that is the one is this assistance of the market to try to spur the market demand that was sort of being left on the sidelines because of the lack of guidance from GHGP, but also to make sure that it was done on a credibility basis. I mean, CRS are curators of credibility, if nothing else, and we made this guidance in a way that if you meet these quality criteria, you can make a legitimate and credible use claim. And we don't mean use like in air quotes, actual use. That was, took a very strict approach to use under this guidance. You can claim you're actually using that particular molecule. And this has been, recently kind of somewhat controversial. There's been a bit of an attack on unbundled certificates or even market-based accounting in general, as if it somehow does not represent real reductions. And some of that has carried through, I think, to the international standard setting organizations like SBTI and or STBI, excuse me, sorry, SBTI and GHG protocol. Both of whom are right now in the middle of updating their respective standards. So I think it's important that the guidance be seen as a way of correcting, making sure that the accounting is correct. And it comes from an organization, CRS, that has an impeccable reputation, and so should be seen as credible. And that should be helpful for everybody. But it also means the guidance can serve as a foundation upon which we can advocate for the expansion of market-based accounting in those international standards. I see the next steps of this as really being the development of sector-specific standards that go beyond the minimum. Remember, the quality criteria that we laid out are the minimum necessary in order to make a credible use claim. It answers the question, is the accounting correct? But it doesn't answer the question, is this the right thing to do? Is it environmentally protective? Is it socially responsible? None of those things are answered. Those are the responsibility of standard setting organizations like CRS is with the Greenie Renewable Fuels Program, where we'll go a step beyond and say, well, okay, your certificates have to meet these criteria, but they also need to be, sourced from, producers that meet, whatever standards happen to be. We already have a biomethane standard that is pretty restrictive out there. We just put out a hydrogen standard for public comment, and I foresee some additional Greenie renewable fuel standards being developed on the basis of this guidance real soon in the future.
Awesome. That's a perfect place to end. Thank you all so much for your contributions to this conversation. We have so many questions that are in the Q&A, so I'm going to try to get through as many as we can. First, I wanted to ask a question from Sean. How long would the IRA repeal and executive orders affect the long-term supply and demand of RECs, specifically in compliance and voluntary markets? I started with a hard one.
With just some high-level comments there. Obviously, the IRA credits were spurring on a lot of new economic activity in renewables and startup companies, project development. And if they're expiring early or very quickly, then pretty much you're limited to what's already shovel ready this year to get access to those credits, and that just means that companies may have to look elsewhere, outside the U.S. to see where there's a better environment for business, and then execute on the things that are already underway. In the case of hydrogen, we also depend on low-cost electricity. So it's not just the 45V credit for hydrogen, but we also depend on a healthy wind and solar industry to provide low-cost renewable electricity. So it really has some pretty big impacts for the country.
So thanks, Chris. Anything to add?
I would just add that some recent research that CRS has been putting out on the impact of voluntary procurement was indicating that in many cases the certificates, the RECs, constituted just the marginal amount to make a project financially viable. That sort of financial additionality component, and without the IRA incentives, it's sort of Ricky's right. They have to look for other sources. It might mean that even with the RECs, there would not be sufficient funding. But even so, we would expect to see, in the absence of those incentives, additional demand for RECs in the voluntary market. So it could potentially increase the price of RECs because of that demand. But I don't see that as being long term.
Awesome. Thanks, everybody. That's a question specifically for Jeff, actually. Sebastian asks that Jeff talks about how the voluntary markets help with RNG development, but buying RTCs to cut down natural gas use can be expensive, so customers aren't always too keen on wanting to do that. Do you think that strong state and federal rules should be enforced to make customers offset some of their carbon emissions?
Yeah,
and I think so. I think so, Renee. I mean, I think it's when when we're in a situation where we see a little bit of stasis in the voluntary markets, it means that we really need the compliance markets and regulators to pick up the slack. And so I think in this case, what we want to see is things like renewable gas standards and clean heat standards, for example, right? We want to see those enforced. We want to see, those represent kind of all the above opportunities, right, to reduce emissions across utilities, from heating, industrial, commercial, residential heating. We want to see opportunities to reduce emissions in the transportation space, as clean fuel standards do. So I think that's a little bit of a challenge in the current regulatory environment, but hopefully, right, and certainly perhaps at the federal level, but we're hopeful that at the state level, and across other sort of subnational jurisdictions of government, that we can continue to see kind of regulations which very much valorize and appreciate the RNG value proposition, the methane abatement that upstream, the value proposition that RNG production offers in terms of abating methane emissions that offers, as well as just broader kind of decarbonization of gas supply chains. So I hope that gets to the meat of the question. I didn't see it written in the Q&A, so this is my best recollection of what you communicated.
I think you answered that fantastically. I do have some questions, a couple actually, that were asked about the biogas regulatory reform rules. Specifically, how much has the biogas regulatory reform rules related to RIN tracking influenced the guidance? Was that part of the conversation at all? Or how has it improved the traceability of renewable fuels from the supplier to the end user?
Yes, I can answer that. And the answer is none at all. The guidance, it was designed to be to some degree fuel agnostic. It's for clean fuels, but it could actually be used for any fuels. All it really does is set the criterion for how the certificates have to be. How do the certificates have to be conveyed? What information has to be on them? How must they, how do they work within a transaction in order to support a credible use claim? So it's not specific to, it doesn't have any specificity to the RNG, our reforms. It doesn't, it also doesn't have any impact on traceability per se. It's the fact that you can't trace the fuels now within a common carrier pipeline system within these sort of linked shared distribution systems that is the reason why those certificates can be transacted in the first place. And I think it's important, that might call for then the expansion of common carrier pipelines, and certainly in the United States, the interconnection of existing pipeline systems so that you can create, a larger market by which the fuels are not only, deliverable necessarily, but you can trade the instruments that represent those fuels across larger geographies.
Awesome. Thanks, Chris. Anybody else want to comment on that one? Great. I love how fast we're getting through these. We're getting to get through a couple more than I thought we were. I think we probably have time for one or two more. John's interested to hear more about CI scores and how it relates to this initiative. Is the intention of the Clean Fuels Guidance to provide voluntary buyers a pathway to making credible greenhouse gas reduction claims under the Scope 1 greenhouse gas protocol? And if yes, how does CI scoring play into that calculation?
I can answer that one too a little bit. Under the current GHG protocol, the Scope 1 reporting is supposed to be gross emissions. So you're not supposed to net out your emissions and you look at avoided emissions or even emissions reductions in order to come up with that number. I've heard from many, several enough respondents that it must be widespread that they're utilizing the sort of the market instruments in order to adjust the CI score as a way of sort of a backdoor way of getting that into Scope 1, of reducing their Scope 1 emissions on the basis of those reductions. Strictly speaking, that's not allowed under the current GHG protocol. But if it's happening anyway, and it points to a very important thing, which is the need to bring in emissions reductions and avoided emissions into the scopes somehow. And I'm not saying that necessarily this is market-based accounting is the best way to do that, but we're definitely going to be advocating for market-based accounting across the scopes. There's the justifications that are made for permitting market-based accounting for electricity and other energy sources under Scope 2 are just the same as legitimate under any of the other scopes. There's not a rational basis for denying market-based accounting under the other scopes. So I'm sure we're going to be having that debate with the governing bodies of GHG protocol and with STBI or SBTI, in the coming months as they do their updates. But I think it's important that we advocate for that because there's obviously a great need to bring in those reductions into the scopes across the scopes.
Chris, just to add to what you just said, in Scope 2 reporting, you show it both ways. You show it market-based and you show it location-based, and that way the end user can decide which way they want to take from the reporter. And we could do the same with Scope 1. We could show it market-based, we could show it gross and market-based, and that way it's both are very clear, and you gain more information, you don't lose anything. And so I'm not I mean, the GHG protocol is going to go through its own process, but I think it's very straightforward to show it both ways.
Yeah, absolutely.
Yeah, and just to pile on there, we also are in favor of the market-based, location-based kind of dual reporting structure. So
Awesome. Great. Thanks, everyone. I think there's one last question that I think I'll actually be able to answer. The question is, what are the next steps for this guidance? Do you foresee there being any future iterations? And should there be feedback that comes in from the industry once it's tested in the markets itself? We're actually already working on a version 2. That's how fast we move here at CRS. We're finalizing some of the examples that we put into the guidance document and also taking any input from others that weren't able to participate in the working group now that everyone has had a chance to review the document. Next steps for the guidance document itself, we're going to put out a V2 in the next coming months. And then next steps for CEAP related to clean fuels is that we are going to start working on more initiatives that are focused on clean fuels. CEAP is primarily focused on electricity, but because of this wild success of this initiative and how many more organizations we were able to partner with and learn from, we definitely want to start growing CEAP into the clean fuel space more and more. So stay tuned for more opportunities to join. On that note, I think that we have a ton more questions left, but I will definitely feel free to reach out to all of you individually with those answers via email. So thank you for those submissions. I'm going to share a couple more resources before we head out. Let me share my screen. Okay, thank you to all our panelists for joining today. I'm sorry about the European perspective. I think Tim had some technical difficulties and wasn't able to join, but I'll definitely alert him to all of you guys asking your great questions and tie him in with any ones that are European specific. Here are some links to access all of our resources on the resourcesolutions.org website. Take a look, especially at our market-based accounting for clean fuels guidance. That was a topic of today's conversation. There are also a couple different sector-specific background reports that could be really useful if you are in a specific sector and want to learn more. Like I said earlier, we do have a few openings on our advisory committee, and it is a fantastic way to be involved with the goals of CEAP and planning what initiatives are worked on every year. For example, an advisory committee member was the one who suggested that CEAP focus on a fuels initiative, and now here we are. So that could be you for the next great idea. Other ways to get involved is sponsoring an initiative. This is another great way to work closely with us on an initiative topic that you're specifically interested about and see how our team operates. These working groups are typically invite only for experts in their respective fields. Our upcoming initiatives include topics surrounding hourly accounting, energy storage, and standard delivery clean energy. If any of these are interesting, reach out and we can see how we can collaborate or have you on our working groups. I'd also like to share our upcoming conference, Renewable Energy Markets, or REM, which is based in Houston this September. We have an entire fuels-focused pathway with multiple sessions and power tables all about fuels. Some session topics include updates on the IRA and other policies supporting renewable fuels. Another one about hydrogen, expected hydrogen market changes resulting from the final 45V guidance. And another one that's focused on understanding renewable fuels in an international context. We have a couple other ones as well, too. So definitely feel free to participate in REM. Registration opens up in a few weeks, and we're super excited to see you there.
If I can just put a plug in real quick at REM, there's going to be a pre-conference workshop that is a deep dive about the guidance. So if you have real technical questions, I think that's a really good venue to hash them out. We'll have hours to speak about it.
Did you hear that? Hours to speak on it. Anyways, to wrap up, thank you to our panelists and their participation today, and to all of our participants. Everyone here at CRS and CEAP are very appreciative of all of your contributions to the clean energy space and to your ongoing support of our programs. Thank you for your time today. Please reach out with any questions or interests. We'd be happy to find a time to talk with all of you and to get you more involved in our upcoming work continuing into clean fuels. Thank you all for your time. See you next time. Have a good one.